So guys, interest rates, those tend to ebb and flow over time. As you look historically, we've gone through a really interesting time where rates were so low coming off the Great Recession, where they were kept, really artificially low for a long period of time, and there just wasn't a return there. The savers out there that were trying to get money, interest at the bank, were not getting it for a long time. Times have changed now. These rates have come back up here in a short amount of time. How is that an opportunity for retirees right now?
Yeah, definitely. So we are in a positive rate environment. Rates are much higher than they've been historically, especially if you're looking back the last 10 years. And that makes it a great time to look at these opportunities, because you can lock into a longer term rate. There's CD rates out there, but generally those are based on 1 to 2 years max. We have some products that you can go out 5 years or more, and you can have some really high rates and lock in your savings. And actually, there's some tax advantage there as well, because you don't pay taxes on your gain on an annual basis. You can allow for compounding of that interest, and you don't pay the taxes till you take distribution down the road.
Sure. And why is it important, Trent, right now? I talked to a lot of folks, and I'm getting 5% at my bank and my money market, which is a pretty attractive rate relative to what they've had. Now, inflation's 7 or 8% or whatever you believe it is. The government tells us one thing. I feel a little differently when I go to the grocery store. But the bottom line is, those rates aren't going to be there forever necessarily, are they?
No, and like Eric alluded to, folks are happy with their 4 or 5% CDs now, but over the long run, that's not going to be the case. We all know that. That's going to change. So like Eric mentioned, these are strategies that are letting you lock in those returns for a longer period of time. And especially as you're approaching or in retirement, that's a little bit more peace of mind. You're at those rates for a while.
Sure. And the Fed's already talking about lowering rates, maybe as soon as September and maybe a couple times before the end of the year. So these rates that we're experiencing now aren't here for the long haul, but and some of the annuity type based strategies we're utilizing to help protect people's retirement. Now is a good time to maybe review products that they've had in the past, or strategies they've purchased, different annuities, and anytime in the last 10 years, anytime beyond 2 years ago when rates started coming up. How is that an opportunity right now, Eric, to kind of take a look at their annuities and perhaps do an annuity review or refi their annuity, as we like to call it?
Right. Yeah. Great point. The industry's changing a lot, and it's changing for the better. So there's some products out there now that have some bonus incentives on signing a new contract and starting with a new product. And so we can explore if there's opportunity to net benefit what they have now and maybe move them into a product that has higher rates, higher participation rates, and just better returns long term for their retirement savings.
Right. And that's because of, if they purchased that annuity contract, say 5 years ago, it's just a different interest rate environment, right? It's not that those contracts are necessarily inherently bad. It's just that they purchased it at a different period of time. Kind of like somebody that got a mortgage a few years ago was really happy with their 3% rate on their mortgage. Somebody buying a house now is probably not as happy, and it's cost a lot more costly. It's kind of the opposite for annuities, right, Trent? With interest rates increasing now, they can get those higher rates on their investments and really put themselves in a better spot from an account value standpoint with some of the bonus strategies Eric talked about. But maybe speak to how, with some of the investment strategies available, the indices, whether it's cap rates, par rates, fixed rates, how that can benefit them going forward.
Yeah, well, when you look at folks who got into their strategies 2-3 years ago, they're tied to the rates at that time, right? So as you said, we're looking to refi your retirement. You're able to now tie your strategies to these current rates, these caps, participation rates today, and that's really what's letting folks better position their dollars as they're heading into retirement to work harder for them.
Right. And as we look at that, it's really just a math problem, right? We're looking at, where are you now? Where can we put you now in terms of an account value? But more importantly, where can we put you over the next 10, 20, 30 years of retirement in terms of the upside on your value of your account, right? So not only can we get them to a point where they're starting with a greater balance today, but we can really grow at a much higher rate and have the potential for much greater growth than what they're tied to in their existing contracts. So that is a huge opportunity. And for anybody out there that's holding an annuity that's more than, say, a year and a half, 2 years old, that's really an opportunity they should take a look at.